Before we get into lecture, which is going to be the new material, actually, you may or may not have read it yet, chapter 7. For some reason, I was having problems with Connect allowing me to add an assignment, but you'll see it under a week 9 directory. So it'll be chapters 7 and 8 and just do the smart book thing. That's going to be due Monday. Now, Sunday, we had set that date for completing the first 3 modules of the BMC. Last time I looked, there were about 23-ish of you all signed into the BMC and logged into the class itself. So if you haven't done that, you're running out of time. The best way to get in there with the least headache is to actually go to the physical terminal. And we just walked through this process earlier this morning. And so once you get in there, you log into the terminal using your terminal login, and then you type in BMC into the little blue entry bar and go to sign up for BMC, and you put your name, your email address, and then click down there where it asks if you're a member of a group, and that's where you put your class code and you sign in. You could do a little bit of the BMC while you're there, but once you sign back out of the terminal and you're at home, and you just open up a browser and you go to portal.bloombergforeducation.com, and you can then continue working on the BMC without being at the terminal, without remotely logging into the terminal, which I know is a royal pain. So once you've created that BMC account within the terminal, you're all set to go. And by the way, I've got I sent out this announcement. I've got a playlist with lectures and so on, but one of those items is this little short video that I did on Bloomberg market concepts. So that basically outlines, or it goes over in a little bit more detail, and you can walk through with the screen what I just got done saying. So make sure that we need about 20 more of you all, 19, to get signed in there. Make sure you're using the right class code. We also discovered, and I don't necessarily recommend you doing this unless you have to, but we discovered that if you have a friend in JCU who is not a Bowler student, who will let you borrow their email if there's some snag with your own email, whatever that may be, and we've encountered several of them, so it's not you, it's more about the system. We've not had success in getting a second email for an individual, but you might be able to borrow an email as long as that person doesn't ever want to do the BMC. Because once you've done it with that email, you can never go back into it. And Bloomberg is very inflexible about resetting accounts. I've asked them, and they won't do it. And then John Carroll, we can't get IT to create a second email address for any of us. So that might be an alternative if you encounter a problem. Feel free to reach out to me, but the first step would be look at the video. Second step would be make sure you call Bloomberg if you have a login error or something like that. But then reach out to me if you're having problems, and I'll try to walk you through things if I can too. All right, so don't forget, Sunday night, that's due. And then Monday is going to be the reading. Questions before we get started? I don't see anything, so pardon me. All right, so let me flip over to the slides. Chapter 7 here we're going to get started on. And Chapter 7 is really foundational to the stuff that we study as finance students. It talks about some of the very foundational concepts that are extremely important. Chapter 8 continues to develop those, and at the end of Chapter 8, we're actually going to see where the capital asset pricing model comes from. But we need this more elemental material in order to get to that point. So this is really, really important stuff. Now, this won't help you as much with the security analysis, but it's important that you understand where all of this material comes from. And let me just shrink myself down here a little bit and get out of the way so we can do this. All right. So let's start off with, can investors beat the market? What do you all say? Yes or no? I didn't set up the poll. What do you think? And obviously, this is our local market here. Not all that different, just selling a different underlying, if you will. Can you beat the market?
I'd say almost always no.
Okay.
Few
Zachary?
exceptions out there, I bet, but I think it's no.
All right. Anybody else want to weigh in on that?
I would second that.
Okay. So no. Certainly, that's my answer too. Thank you, Zachary, or Zach and Brett. Yeah, the answer is no. The short answer is no. The long answer is maybe sometimes in very limited circumstances, don't count on it. Especially if you've beaten the market a few times, or it looks like you've beaten the market a few times. Don't assume that that's going to continue either. So, yeah, the big question is, why can't you beat the market? Or why is it only in extraordinarily limited circumstances that you might appear to be beating the market? And I underline appear because that may or may not be true if we capture all of the costs that it takes us to, quote unquote, beat the market. Well, there are three forces that are going to be driving a lot of this. One is investor rationality. We're assuming that investors are rational. And if investors are rational and they behave in that way, then more than likely the market price is going to be an efficient price. It's going to reflect the true underlying value of that asset. Now, not all investors are rational. I always use the example of when I was trying to convince my dad many years ago, when I was first a student at Arizona studying finance and learning about diversification and the importance of that. And he had bought a stock that was a local company. They made industrial, I forget what it is. It was Beloit Corporation. Or excuse me, not Beloit Corp. It was Regal Beloit. And they made, some sort of industrial items. Thing is that he bought 100 shares for himself, 100 shares for my mother, and they had those for decades. And the company had split, and they ended up having several thousand shares of this company. And it had done well. Trouble was, it made up over half of his portfolio in terms of their net worth. And so I kept trying to convince him, Dad, you got to sell some of that. Oh, I'm going to take a tax hit if I sell it. I said, you're going to take a hit if Regal Beloit goes down too. And again, this is the town I grew up in, kind of one-horse town, right? Well, three-horse town. Regal Beloit, Beloit Corp, and Fairbanks Morris were the three major employers and major companies in the town. So one of those goes down, hey, it's not good for the town, value your house goes down, etc. Could never convince him. So there's a lot of irrationality out there, even among people that you know, and you try to convince them to be rational, and it doesn't work. Luckily for him, Regal Beloit stayed up, and he was fine. But second thing that drives this is that if we have deviations from rationality, they're independent. There's this acronym in statistics. I don't know if you've encountered it I don't know if you get into that in EC 210. Have you ever heard of IID? No. Independent and identically distributed. So as long as the deviations from rationality are independent and identically distributed, they cancel each other out. Independent meaning that if I'm irrational in one way, maybe I'm bullish on a stock. Let's say we've got a stock whose price is actually fair, and I think it's undervalued, so I want to buy it. You think it's overvalued, so you want to buy it, or you want to sell it rather. You want to short it. Excuse me. So we're both irrational, But if we both act on that irrationality, my buying, your selling, cancels each other out. That's the idea of independent irrationality. So deviations from rationality or this irrationality are independent. They'll cancel out, and we end up with a zero at the end of the day. One other condition, I couldn't find a better photo to represent this than this movie. I've never seen it, so I don't endorse the movie per se, but maybe it's good. Anybody seen it? I don't know if there's anything real finance in it or if it's all just drama. But in any case, arbitrage. Arbitrage is the other thing that keeps markets efficient. So the moment that conditions 1 and 2 don't prevail, let's say we have irrational traders and the irrationality is all one-sided, or at least it doesn't entirely cancel each other out, then we have these arbitragers who jump in and they say, oh, hey, I see a price deviation. It shouldn't be there. I'm going to jump in and I'm going to take advantage of that. And I'm going to make some money. What I'm going to do is my actions are going to drive the price back to efficient levels. So these three conditions are really, really powerful conditions. And the key to it is down here in the box on the right. Any one of them can drive market efficiency. So that's kind of the underlying on all of this. And then we have a whole bunch of finance professors and a whole bunch of finance professionals out there looking for those deviations from rationality, those those mispricings. And we'll see a number of those as we go through this. The interesting thing is that when we uncover any sort of anomaly, and that's the term that gets used, we're looking for anomalies to market efficiency. In fact, some of my work has been directed in that direction, looking for pricing anomalies that can easily be arbitraged away, but maybe for whatever reason are not. Maybe nobody even looked at it. And as we look at them and as people become aware of them, all of a sudden they start disappearing. That's the interesting part about it, is that some of these anomalies that were discovered back in the 60s and 70s and 80s in the finance research, either the person doing the research themselves capitalized on them. And that's one of the beauties of actually being a professor of finance and a researcher, is that you get paid to look for these anomalies. And if you are lucky enough to find one that you can truly capitalize on, there you go. You know, not only do you get to publish that paper, but you get to capitalize on it before you publish the paper. Of course, do the capitalizing before you publish. But you get the idea. So that's there are a lot of people after this. So that's kind of another reason to assume that, yeah, markets are pretty much efficient, and it's really going to be difficult for me, an individual, to beat the market. And we're going to define what that means too, because it's a very clear definition in terms of what it is to beat the market. Before we get there, I want to clarify there are a couple of terms here that I want to make sure that we have a common understanding and definition for. These get mixed up a little bit. Abnormal returns versus excess returns. An abnormal return is a return, the component of the return that is not due to systematic influences. In other words, something that deviates from CAPM. In our case, if it deviates from CAPM, then we have an abnormal return. An excess return is simply, it's not an abnormal return. It's not a synonym for abnormal return. It's simply the difference between the return on a risky asset and the riskless rate or the risk-free rate. So be careful when you see these two terms. I've even seen, and I haven't double-checked in the 9th edition, in the 8th edition of our text even, there was a little bit of, mushing together of those terms, almost using them as synonyms of each other. And they clearly are not synonyms. Excess means I'm getting something to take a risk above and beyond the risk-free rate. That's not what I'm looking for. What I'm looking for, if I want to beat the market, is an abnormal return. So always keep that top of mind. And by the way, it also has to be consistent. We have to be able to do this regularly. Are we going to get lucky sometimes? Yeah, absolutely. I mean, look at the price series. You know, an expected return is the average return that stock should generate in any particular period. The actual return is going to deviate, right? It's going to be 1% one period, it's going to be 10% another, it's going to be -5 another, but on average it's going to return 7%. So that's not an abnormal return. That's simply a realized return, which is part of potentially a normal price series and an expected value or expected return for that stock. So that's what you have to regularly beat this in order to truly say that you beat the market. Back in the 70s, Gene Fama, Nobel Prize winning, oops, where'd my screen go? Nobel Prize winning economist and University of Chicago finance professor. Let's see if that does it. I still have a screen here. There we go. Gosh, technology again. All right. Nobody move. It's working. Developed some benchmarks for us to help understand the efficiency of markets, because in order to determine whether we're beating the market, we have to determine how efficient the market is to begin with. And he set up 3 different levels of market efficiency. And again, this was to help us as researchers to try to understand where our markets currently are right now for a particular stock. So he posited these 3 forms of market efficiency: weak form, semi-strong form, and strong form. They are all based upon how much of the total information set that's out there is embedded in the share price or the price of the asset. It's not, and I've found in the past that students can easily confuse how much information is embedded with the price with how much information is available. We're assuming here that all information is out there, whether it's privately or publicly held. The way we figure out whether a market is weak form, semi-strong, or strong form is by looking at the price and determining how much of that information is embedded in the price, or stated slightly differently, could I use information that's available to beat the market, to create an abnormal return? And if I can, that means that that information is not embedded in the price yet. All right? It's a little bit confusing when you first start thinking about this. You can think about it as kind of one envelops the other envelops the other. So if weak form prevails, then semi-strong and strong form are just out entirely. If markets are weak form efficient, then it doesn't necessarily mean that they're semi-strong or strong form. We still have to check. But if they're semi-strong form efficient, then that means that they are also weak form efficient. And if they are strong form efficient, then that also means that they are semi-strong and weak form efficient. So the strong form is envelops the other 2 forms. And it could be that we find there's another one more category. The markets may not even be weak form efficient. In fact, there's an entire industry set up under the presumption that markets are not weak form efficient. We'll talk about what that industry is in just a minute. Okay? And just let me reiterate. This is not about how much information there is. It's about how much information or how much of that information that exists is embedded in the price. Now, how do we get information into a price anyway? Anybody have any ideas? Do we just kind of slice the price open, stuff it with information, and then stitch it back up like a pillow or something? How do we do that? How does price get embedded in, or how does information get embedded in price? Think back to Econ 101. How do we get information in price? How do prices move? What makes prices move?
Supply and demand.
Yeah, thanks, Noah. Exactly. So, and it's in particular, it's a disequilibrium between supply and demand, right? Prices will stay the same as long as supply and demand for that particular thing are equal to one another. But the moment we have a shift in either one, either direction, prices are going to have to move. So if right now I have an equilibrium between the number of shares demanded and the number of shares supplied, the price is going to be stable until I get another investor coming in demanding more shares. And all of a sudden now I have more demand than I have supply. Prices are going to go up to look for more supply so that eventually we can come back into that equilibrium. And then we have equal demand and supply at a higher price level. And the reverse is true, and prices would go down. So that's really how I get information into the price. I'm investigating a particular company. I find that my expectation is that it's undervalued. So what do? I go out and I buy that stock. That creates that disequilibrium. And then maybe even in the process of buying that stock, I drive it back up to where I think it's fairly valued. So I bought some at a very low price, more at a slightly lower price, and then I stop buying as soon as it hits fair value. And in fact, what I might do is I might start turning around and selling it and taking a profit out of it at that point, and then move on to the next stock. But that's really how information gets embedded into price, is through trading. So if we don't have trading, we don't have changes in price. Or, and this is another interesting point, if we don't have changes in information, we shouldn't have changes in price. Look at all the trading that goes on in the marketplace. Billions of shares every single day. Billions. It's incredible. There's so much trading. That must mean that there is just tons of information out there. Not exactly, right? And in fact, I've done this in a lab setting. And there are a number of experimental labs. We can even do online type experimental labs where we can set up a couple of very basic securities with 2 or 3 outcomes in the future. Some people know that outcome A isn't going to occur. Some people know that outcome C isn't going to occur. So if we put all that information together, we know that outcome B will occur. And so we should know what the price is. And even when we do know what the price is, the odd thing is that we'll still see these are undergrads just like you. These students would still trade because they felt like they were supposed to. So sometimes I wonder if some of our trading volume isn't simply due to just, people thinking, hey, I got to do something. I got to trade, even if there is no information. I don't think that's a good idea. Certainly won't make you money. Let's see if we can get there. We go back. All right. Come on, behave. This thing gets overheated, unfortunately, and I guess that's what's going on. All right. So already more or less talked about this information here. Does old information help predict future stock prices? Well, that's tough to say, really, right? there's certainly something there. The company is still in the same business. They still have the same relative level of risk and things of that nature. But what we're really trying to capitalize on is what's going to happen tomorrow. What new information that may bear on the price of something or the value of something is going to happen tomorrow. We also have to take into account trading costs. And when we talk about beating the market, we're talking about beating a buy and hold strategy. So that has to be our benchmark, and we have to do some sort of risk adjustment here. And if we don't do a risk adjustment, then I always question, are we truly beating the market, or are we actually creating a riskier portfolio that appears to beat the market simply because we haven't adjusted the benchmark for the risk that we're taking in the actively managed portfolio? This idea here about technical analysis. No matter how often a particular stock price path has related to subsequent stock prices, there is no assurance that this relation will occur again in the future. Remember, I didn't fix the author's slide. It's not a relationship unless it's between people. It's a relation if it's just some sort of mathematical thing. There is no assurance that this relation will occur again in the future. So what's that pertain to? Anybody done any exploring into moving averages and things of that nature? You can look at 50-day moving average. You can look at a 200-day moving average. There are people that will tell you that when one crosses the other, one direction or the other, that's a buy order or a sell order, or trigger rather, signal, what have you. Basically, there's pretty good evidence that you shouldn't rely on that. Are you going to get lucky a few times? Yeah. In fact, if you all had a coin, we could go out and flip coins in a class this size with about 40 of you. If we did about 4 flips, just the odds of 40 of you flipping a coin, there's inevitably going to be one of you who actually gets 4 heads in a row or 4 tails in a row. In other words, simply by luck, right? Now, if we're doing the same thing in the stock market, and we have each of you doing some sort of technical analysis, which is, I haven't defined that yet, but in technical analysis, we simply look at old prices and old volume. We study that. We look for patterns in that. We're looking for a pattern that might repeat. And so if I had all of you out there working on some sort of different technical analysis trading rule, just by luck, it's more than likely that one of you is going to hit a win on all 4 trades that you make. Now we're going to call you the star trader in the group. However, with the coin, it was pretty obvious. It was pure luck. With trading, it's less obvious. There's a little video that I don't know if we'll get to it today, by Nassim Taleb. It's later in the slides here, where he talks about this, and he makes a very salient point about it. And if it doesn't make sense now, you'll see it definitely in the video. But the idea here is that we can, because the market is so complex, we can easily confuse skill, our own skill, with luck. 2 things going on there. One is the markets are complex. The second thing is that we want to believe that we are good and we're doing something useful and that we have a skill, right? So those 2 things can cause us to start making trades that can severely affect our net worth in the wrong direction. Random walks. Random walks. I'm sure you've all heard that term. There's a famous book called The Random Walk Down Wall Street. Basically, what's a random walk? Well, it's a statistical characteristic that we believe stock prices follow. There's a ton of research out there. I mean, literally thousands of studies that attempt to determine whether stocks follow a random walk. And most of that research suggests that they do. When there is no discernible pattern, the stock price that the stock price follows, then the stock's price behavior is largely consistent with this notion of random walk. So here we see another example of a random walk. If we were in class, I would demonstrate this up front in the class. The other classic, this guy must be a sailor, because the other example is a sailor walking from the bar back to his ship. You know that there's a particular trend. The sailor is probably smart enough to smell where the salt is and knows that the ship must be this way. The part that makes this a random walk, though, is that you don't know which way his next footfall is going to go. Is it going to go left, right, in front, in back? Pretty obvious that we don't really know where that's going. Here's another little more representative example. Now, if we were to look at a price plot of Intel over this period of time, we might see something like this. And if we were to then put some sort of, 50-day moving average and a 200-day moving average, actually that's the other way. I think it'd be more accurate that this was the 50 and this is the 200. And they cross here, and that's some sort of sell or buy signal. That's technical analysis. That's charting, chartists. The various terms get applied to this sort of analysis. But when you look at it on a day-to-day price change, as this plot shows, let me just clear this mess out of here. Oh, I don't have a news. I thought I'd save this as a PPTX, and apparently I didn't. Won't let me erase that. But you get the idea. This looks like noise. Unpredictable. White noise is unpredictable. Now, is there a trend to that noise? Yeah, there might be. That's why we invest in stocks, because there's a trend. But can I detrend that even? Yeah, you can try. There's this thing called the Kalman filter. If you really want to get into technical analysis, start digging in. Google Kalman filter. This is actually, if you're into audio or music, that sort of thing, there are many filters out there that extract noise out of a signal. And it's to create a cleaner sound, cleaner music. Kalman filters, though, get used in finance too, because if I'm seeing a pattern that has a blend of noise and signal, really I want to get rid of that noise piece and solely look at the signal and make some sort of effort to determine whether today's price is above or below that signal. And even that is fraught with difficulty. It's a highly technical process. I've actually played around with it back when I was a student. And, you can do all kinds of esoteric stuff and try to find a method that will beat the market. And the answer is that 99.99 chances out of 100, you're not going to beat the market. And even that 0.01 chance that you have of beating the market, once you factor out all the costs of the other times you tried, the time you spent on it, the trading costs, what you lost, and so on, it's dubious as to whether it's worthwhile. Here's another Uh, you know, I put this up here because maybe you see a pattern in there. Maybe you see, I don't know, an animal or something. I was looking for a particular cloud shot that actually had a fairly obvious pattern of something in it. I couldn't find anything. But maybe, if you turn it on its side, it'll look like, I don't know. I don't see anything right offhand. Does anybody see anything in there? This is what human brains are designed to do. That's one of the primary characteristics of us, right? From the very time we're born, we need to recognize the face of our mother so we can make sure we get back to our mother. So this pattern recognition is something that is just hard-coded into our heads. We're going to see a pattern, whether there's one there or not. We could go out onto the street and look at the water that's staining the concrete a different color and probably see a pattern in some of that. Or we can look up at the clouds, or we can look in the different colors of green in the grass and see a pattern. Does that mean that that thing is there? No, of course not. Why should this mean that there's anything there? Simply because I think I see a pattern. All right. So how new information gets into stocks. In semi-strong, the efficient markets hypothesis states that stock prices fully reflect all publicly available information. So let's go back. I didn't actually give you the full criteria on these various conditions and didn't talk about it enough. So let me go back to this slide. Weak form market efficiency says that the prices already have impounded in them all the information embedded from prices, historical prices, and historical volume. In other words, I could analyze the heck out of the historical price series and the historical volume series, and I still can't beat the market. Now, if I find that I can beat the market, then the answer is the market is not weak form efficient even. And that's really bad for all of us, because we want a market that everybody reasonably can expect is fairly valued. If it's not even weak form efficient, we've got a real problem, and finance is not doing its job to help allocate the assets to their highest and best use. That's one of our fundamental goals in finance, is asset allocation, allocating it to its highest and best use. And if we can't depend upon the prices in our market to be at least weak form efficient, we got a real problem. We're not going to be creating much value for the economy as a whole. So that's weak form efficient. If you could do all the analysis possible on past prices, past volume, and still not beat the market, then the markets are weak form efficient. Semi-strong adds to the weak form by saying that not only is it all past prices and volumes, but it's all past information anywhere publicly available. So I go out to the sec.gov site, I go to Edgar, and I search through the 10Ks, the 10Qs, I search through the proxy statements, I go online, I search all the articles, I understand what was happening in the economy right up to this second. And then I use all that information and I try to beat the market. And if I can't beat the market, then markets are said to be semi-strong form efficient. Let me give you an example of this sort of analysis. What did we talk about on Tuesday? Well, we talked about the security analysis, right? Aren't we using all the publicly available information? Isn't that kind of what I said there over the course of the class? Top-down analysis, start at the economy, go down to the industry, go down to the firm, understand all of the ways that it interacts with all the constituents. Yeah, go out there, find all the articles about grocery stores, the industry, customers, suppliers, margins, dig into that, and then come up with a price and compare it to the market price. So in some regards, security analysis or fundamental analysis is assuming that markets may not be semi-strong form efficient. And this last condition, strong form market efficiency, says, let me add one more piece of information to this whole thing. And I'm going to say that even if I had all publicly available information, historical information, and all privately held information, I still can't beat the market. Now that's a really strong condition, because it's privately held information that you have, that I have, that anybody in the marketplace has. We're assuming that even with that, you can't beat the market. There's a problem with that, isn't there? What did we say about how information gets incorporated in price? By changes in trading behavior, right? Changes, disequilibriums between supply and demand. Well, if I have privately held information that I have not acted on yet, how in the heck is that information going to be embedded in the price already? No possible way. No possible way. So the way I think about this strong form market efficiency is that Fama put this out there as kind of the unattainable. Sure, this is certainly a reasonable thing to talk about, but in practice, could it ever happen? And the answer is no. There's no way. So the only two forms that we are actually studying here and trying to determine whether markets follow is the semi-strong form and the weak form, and then actually that third form, or that fourth form rather, I should say, which is not even weak form, whatever that is. He didn't give that one a name. So we're really studying these two. This one, there's no way that we'll ever get that, because if somebody has private information that nobody else in the world has, and that information is material to the value of a stock, then obviously you're going to be able to make abnormal returns on that, obviously. If I'm looking at a gold mining stock and I'm the only one in the world knows that that company just discovered the mother lode of gold that nobody else knew about, and it's billions of dollars of value, well, of course I'm going to go out and buy the stock of that company. And of course, the price is going to stay the same until I keep buying and buying and buying, and it's going to finally drive the price up. But in the meantime, while it's still on its way up and I keep buying before it levels out at its new value that reflects all of that extra gold that was discovered, I'm making money. I'm making abnormal returns because I'm buying at too low a price. So the semi-strong, or this strong form is really kind of a straw man, if you will. It's unattainable and just there as kind of that ultimate. We would love to have markets at that level, but we know in practice it can never happen. All right. Any questions so far?
I have a quick question.
Yes, go ahead, Julia.
Just going back to like the circle with like the weak,
Yeah.
semi, and strong. So if the market's weak, it can also be semi-strong, or is it just like one or the other?
No, it's the other way around. If the market is, so let's back it up. If the market is weak form, at least weak form, then it's that's it. Now, if we add, so what that's saying is that the historical prices and volumes, if we study those and analyze those, we can't beat the market. Then we would say the market is weak form. Now, if we add to that all other publicly available historical information, and we can beat the market, then it's not semi-strong, but it is weak form. Okay? However, now let's have another example. Let's say that we find that we can't beat the market with past prices and volumes, and we add to that all other past information, and we still can't beat the market, then we would say that the market is semi-strong form efficient.
Okay, yeah, that makes sense. Thank you.
Sure. So the stronger form always envelops the one below it. So you could say, in the case that I just gave, you could say that the markets are both weak form and semi-strong form efficient, but it's easier to just say semi-strong form efficient because that encompasses weak form already. So you could say it either way. The other, also let me, while we're here, let me mention that most of the research suggests that markets are semi-strong form efficient. And when I say markets, I'm talking about the most highly liquid markets. And I always use the example of, say, we're talking about the S&P 500 stocks. That's what the vast majority of the research that's been done suggests, is that markets are semi-strong form efficient. So the next question that you might be thinking is, so why in the heck is Dr. Elliott assigned this security analysis to us? Because he just got done telling us it was a waste of time. Well, it's a bit of a conundrum, isn't it? Let's back up a little bit and think about that. First off, I said S&P 500. Sprouts Farmers Markets is not an S&P 500 company. So right then and there, well, maybe there is some value to that. But let's back up even beyond that. And let's take an S&P 500 company. Let's take a company that everybody's familiar with. Let's say Apple. Suppose that there were no analysts that followed Apple. There actually are 30 or 40 or more analysts that follow Apple. But let's say that we created a parallel universe and nobody, not a single analyst, has followed Apple. Do you think that Apple's price is going to be efficient? Is it going to reflect the real value of Apple? Even if Tim Cook didn't do anything related to his information about Apple, or anybody else that was an employee of Apple. Of course not. The price of Apple could not possibly reflect that, because we have to actually trade on things that we know in order for the price to reflect that information. So if nobody's analyzing it, nobody's making trades on it, then the price couldn't possibly reflect the underlying value. So that first analyst that shows up and says, I think Apple might be worth my time, and I'm going to investigate it a little bit and see if it's fairly priced. So I'm going to talk to Tim Cook. I'm going to look at the 10Ks, which, by the way, nobody else has already looked at yet. And I'm going to try to determine whether the price that I see in the market is representative of the price that this analysis leads me to believe that it's worth. And the answer is probably going to be, oh, it's way off. So now the analyst is going to make recommendations. And let's say that the price is way too low. So the analyst is going to come out with a buy recommendation. What's going to happen? Well, if I trust the analyst, I'm going to run out and probably buy some Apple stock. And what's going to happen to the price of Apple stock? Boom, it's going to go up. And at some point, it's probably going to reach what the analysts expected the value to be. And what about a second analyst? Are they going to add any value? And the answer is probably yes. Apple's a very complex company. There's a lot of moving pieces, so maybe that first analyst missed something. But what they add is, at the margin, less than what that first analyst added. And what about the third analyst and the fourth analyst? You get the idea. Each analyst is adding something to the mix, possibly, but the value, the contribution that they add gets smaller and smaller and smaller. Would it be worth it for us as students to analyze Apple at this point with 40 or 50 other analysts following Apple? No, of course not. It'd be a waste of our time. So that's kind of the conundrum, right? We have to have some coverage in order for the prices to reflect the information that's out there, because otherwise, how does that information get into the prices? So when I talk about the S&P 500 being semi-strong form efficient, you can also read into that mid-cap stocks probably there's probably a lot of room for us, you and I even, to go in there and analyze those mid-cap stocks and find something that is misvalued. I mean, heck, that's what Warren Buffett does on his weekends, right? Warren Buffett's reputed to read annual reports just for bedtime reading, casual reading, sitting out in the back in the nice sunny day. Let me crack open a 10K. Can't wait to dig into that. So he's looking at these smaller companies that might be less efficiently priced. He's looking for that needle in the haystack, and he's found quite a few of them. So be very careful I want to be very careful when we talk about price efficiency. Most of the studies that we're looking at here, and most of the studies that find that markets are efficient, are talking about large cap stocks in highly effective and efficient marketplaces, i.e. the NYSE and the NASDAQ. Now, if we go overseas, we may find some mispricings in large cap stocks overseas, relatively large cap, at least within their own region or country. They may not be considered large cap in the US. We might find some mispricings there. Any other questions about what we've talked about so far?
I have a quick question.
Go ahead, Kristen.
So when you're talking about these market efficiencies and you're saying how useful they are in beating the market, as we discussed, since you can't really necessarily beat it, it's not is it referring to how useful the information is in attempting to beat the market? Is that how they're staging it?
Yes, exactly. That's exactly correct. Yep.
Okay, thank you.
Yeah. And the mistake that I've seen people make in the past is that they say, well, that information isn't available. No, the information is all out there. Is that information reflected in the price of the stock? Yeah. And if I had private information, then I could probably beat the stock. I think that's what you're basically saying. If I were to have that private information, then yeah, you could beat the market for sure. What else? These are weird concepts, so even if you don't have questions now, if they come up, please feel free to jump in. All right, so let's see. Okay, so here we have in the blue line, this is the, come on back here. This is the price movement along here. We get a new piece of information at time 0 that causes the value of the stock to go up. So this would be a theoretical ideal, is that the stock price goes up and then no new information, so it stays stable. That's a theoretical. So we've got one piece of new information. Now, what you see in the dashed lines are how markets often behave. Now, this relative, here we're talking days, but in other cases we could be talking hours, we could be talking minutes, milliseconds, or on the other end, we could be talking about weeks or months. But here are two different reactions that might deviate from the idealized here. And so here's an overreaction. So the market it obviously reacts to that new piece of information, but it puts the value way too high, and then the market kind of figures out, oh, wait a minute. No, actually it's down here. And it comes back down to where it should be. Now, that still reflects market inefficiencies. Those types of inefficiencies, this overreaction, that might be something you could capitalize on. There's possibilities that, the market either overreacts, or here's the case of it underreacting. It recognizes that information and the price starts to go up, but it takes a while for it to reach that idealized or theoretical value. So that's an underreaction. Either of those are quite frequently found in the price series. I've done studies where we find that. Many, many different types of events that are fairly isolated. And that's the trick of doing any of these studies. You have to find an event that is easily time-stamped so you can know where time zero is. And when did the public become aware of this piece of information? At that moment, how did prices react? And then I look minutes or hours or days afterwards, and I also follow how the prices reacted in that time period. And if I see some pattern that looks more like this, then I would say, oh, prices are overreacting to this event. Or I might see this where they're underreacting. So those are quite frequent and common price paths that we see. So that is inefficiency. It's not a bad thing necessarily, particularly if instead of talking about days, we're talking about seconds. If price snaps to where it should be within a couple of seconds, hey, I'm happy with that. In fact, if we were looking at changes in yield or some sort of change announced by the Federal Reserve Bank, we can see this actually happening in milliseconds. After about 10 milliseconds, the algos have already capitalized on it and prices already moved. That's how fast prices move in these very efficient, high liquidity markets. So the type of study that we use to look at this is called an event study. And it's called an event study because we're looking at a particular event that has a particular discrete announcement date. So maybe much of my research centers around stock split announcements. And that's the event, the announcement of a stock split. So I can fairly easily define the minute or the second that announcement hits the market. Oftentimes the announcement actually hits the market after the market closes, which is kind of convenient because then I can see what happens between the close of the market, then it gets announced, and I can look at the open market price. And I can assume that the bulk of that change is related to the stock split announcement. So this is the event study method. And basically what we do is we have to adjust the prices. We're looking at returns here, and we have to adjust the returns for the level of risk. So what we do is we use the capital asset pricing model for the most part to do that. There are several versions of that. The one that we're going to be studying is the original CAPM, and that one just has a single factor. There's the Fama and French three-factor model, which is also a very well-known, widely used model. And then there are up to an additional 6, I believe we have 6 factors, and maybe we're even up to 7 factors. There are a variety of models. Most of these studies, though, will look at several measures that attempt to capture what we should expect, which is following CAPM or the three-factor model. We adjust the return for that, and then if there's any deviation from that expected return, we call that an abnormal return. And then we do this over thousands or at least hundreds of different events. So I have a stock split on January 2nd for company XYZ. I have another stock split in June for company ABC. What I do is I actually take both of those stock splits, even though they're on very different days. I make the adjustment to the returns that I captured by using CAPM, and I adjust for the level of risk, whatever their beta is. I make that adjustment, and then I line those guys up. So I line them up, that January 2nd and that June date, I line up, those are both times 0. And then I average all of those together. I've got hundreds of those sitting together with one another. Let's see, we're at about 1:30 here, so I'm going to, let me skip ahead here for just a minute. What I want to do is show you this video by Nassim Taleb, and then we can come, if we've got any time, we'll come back and pick up and continue, and then finish up the chapter next week. This is the first book by Nassim Taleb. He's gone on to write numerous other books. Very, very bright person on this subject. He started off as a currency trader, and his experiences with himself and his fellow traders kind of gave him the premise for this first book. But then he's gone on and he's kind of become more of a researcher as opposed to a practitioner. But I think this is what I was talking about when I used the coin flip example relative to the stock trading example. By the way, this video, unfortunately, I don't have a good discrete video of Nassim himself describing his first book, Fooled by Randomness. But this is a video done by the Swedish investor. Most of the stuff that he's put up on YouTube is fairly decent. And it's one of these animation things, so bear with it. I think it's still very informative. And let's see, I think I hit that. And we'll
Ever feel like you put out fires all day in your service business and don't have any time to work on scaling it? That's where I...
All right.
Probability is a difficult concept to grasp. Few people tend to understand it on a theoretical level, with the exception being people with college degrees in applied math, statistics, computer science, engineering, physics, and some finance programs. Among these, even fewer tend to understand the real-world implications of the mathematical theories. In Fooled by Randomness, the best-selling author and professional trader Nassim Taleb takes a stab at this and attempts to explain how a world dominated by randomness have us fooled in many situations. One field in which people tend to be extra vulnerable of being misled happens to be the financial markets. Let's dive in and see how. Takeaway number 1. Survivorship bias. Consider this scenario. Sven Svensson is a 22-year-old and he has already amassed a fortune of $3 million. Are you impressed by Sven? One might be, until you realize how he got his fortune. He got it through playing Russian roulette with the Swedish mafia on 3 occasions. Each wager was for $1 million. Sure, he might be the lucky owner of $3 million today, but in 42% of other possible realities, he died before his 23rd birthday. Now, of course, this is not a problem. Sven may do whatever he likes with his life. Problems start to arise when Sven explains for other young people how they easily can gain $3 million in their early 20s. Just play some Russian roulette. It's not as dangerous as it seems. The trick is to blink 3 times, as hard as you can, and then make a clap before pulling the trigger. Trust me, it's bulletproof. This is a clear case of survivorship bias. Younglings all over the world may admire Sven for his Russian roulette skills and try his strategy in the game themselves, thinking that it's bulletproof. Consider another situation. Martin the monkey is throwing darts on the stock listings of the OMXS30 index, which is an index of the 30 largest companies listed on the Swedish stock exchange. He did this on January the 1st of 2018 to pick 3 companies. Today, his return is 12%, which is a handsome profit considering that the OMXS30 is down by about 10% this year. Martin is very proud of his returns, and he tells all his monkey friends about his brilliant strategy of picking stocks through dart throwing. He informs them about which velocity to use, how to add an advantageous spin, and even what kind of food they should have the day before the throwing. The problem is that neither we as investors nor Martin himself consider the other possible outcomes of Martin using this approach. What if he, instead of hitting Ericsson with his first arrow, had hit SKF? Then his return would have been minus 12% instead of 12%. The issue is that because of survivorship bias...
Let me just point out here too, we have an equivalent. The Wall Street Journal writes up all of the star stock pickers, right? They don't write up the thousands of failed stock pickers. So it could be Martin the monkey that they're writing up about.
we will never hear about the Martins who missed Ericsson for an SKF. The highest performing realization will always be the most visible. The book How I Lost 12% Investing in a Market That Declined 10% will never make it to the bookstore shelves. However, How I Made 12% in a Market That Declined 10% might become the next bestseller. When picking 3 stocks from the OMXS 30 index, the expected return was about minus 10% for 2018. In hindsight, that is. The standard deviation was 11%, which implies that out of 40 monkeys, 1 would have had the same return as Martin, or even better. Let's pretend that there are 2,000 monkeys out there. Then 50 of them would have had a return of 12% or better, by pure chance. And one of them will definitely write a book about it. Takeaway number 2, the skewness issue. During his time as a trader at a large investment house in New York, Nassim Taleb once found himself in a meeting with company stakeholders where they wanted his opinion on the stock market. He told them that he thought the market is likely to go up during the coming week. He said that it's probably a 70% chance that the market will rise. Someone interrupted. "But Mr. Taleb, I just saw you taking a huge short position in S&P 500 futures. What made you change your mind?" Taleb explained that nothing made him change his mind, that he had a lot of faith in his bet of shorting the market. A faint laugh went through the room. The guy who asked about the shorting of S&P 500 futures seemed utterly confused. "Mr. Taleb, I don't understand. Are you bullish or are you bearish?" Taleb explained that he didn't understand the question. Sure, he was bullish, if bullish means which direction he thought the market would go. But it was still preferable to short the market, because in the case of the market going down, Taleb expected a much larger move in that direction. People in general confuse probability and expectation, which is probability times payoff. Consider this stock. It has a 90% chance of going down 10%, and it has a 10% chance of going up 200%. Would you buy it?
You should, by the way.
Well, you should want to buy it. On average, such a stock will yield 11% on your capital. A lot of people are not comfortable taking bets of this kind. In the real world, I mean, where the underlying probabilities aren't as clearly defined as in my theoretical example. Why? Because it hurts a lot being wrong in 90% of the cases. Even the occasional huge wins don't make up for it. In his trading approach, Nassim Taleb loves to take advantage of this skewness issue. One of his main strategies is
Let me just jump in here too. Not only is it the skewness issue, which is just a function of the distribution, right? We've got various moments. The first moment is the one that you all know about, and that's called mean. The second moment is variance. The third moment is skewness. And then we go on to kurtosis, etc. But skewness just means, is it symmetrical or not? If it's not symmetrical, it might be one-sided or another. There might be a long tail on one side versus not on the other. So that's a skewness issue. The other piece that they're really wrapping in here, and I don't think he actually jumps into this, but it's a behavioral aspect, right? It's that we as human beings prefer to win rather than lose. So this idea that, yes, on average, we should take this bet, but 90% of the time we're going to be wrong. We're going to get that no. And that's going to hurt. I mean, it's no matter what we do, we're hardwired for finding a loss to be more painful than an equal gain. So there's this whole area of behavioral finance that he's referring to here as well.
Bleed some frequently, but to make sure that he never experiences a cutthroat loss and that every winning bet is a home run. Takeaway number 3, the black swan problem. What do you think about this statement? Is it true or false? The stock market, as in the Dow Jones Industrial Average, has never been down more than 23% during one single day, during its approximately 44,000 days of existence. Therefore, it can't go down more than 23% in a day. Of course, this statement is false. Imagine someone making a similar argumentation on the 18th of October in 1987. The stock market can't go down more than 13% during a single day because it has never done so during its 33,000 days of existence. This person would be proven wrong the next day, when the Dow Jones Industrial Average crashed by 22.6%. This is referred to as the black swan problem. No amount of observation of white swans can allow the inference that all swans are white, but the observation of a single black swan is sufficient to refute that conclusion. Always be careful when relying on statements such as "the market has never done this before" in your investing approach. Takeaway number 4, Pascal's wager. Always expecting that you can't learn from historically great investors or traders because of survivorship bias and because there might be a black swan lurking around the corner presents a very pessimistic view of the investing profession. And to counter this, Nassim Taleb presents the classic Pascal's wager. According to the philosopher Pascal, the optimal strategy for humans is to believe in God and his existence. For if God exists, the believer will be rewarded. And if he doesn't exist, the believer has nothing to lose. You can reason like Pascal did in your trading or investing approach. If historical data shows that a given strategy is successful, you should use that to your advantage. For if the historical data reveals opportunities for the future, you will be rewarded. And if it doesn't reveal anything at all, you'll probably return the market average anyways. But don't use historical data to decide your risk exposure. This way, you'll get the potential benefits of a strategy that you've noticed to be successful in the past, while you avoid the risk of overestimating its accuracy. Takeaway number 5. The 5 traits of the market fool. According to Nassim Taleb, the market fool has a tendency to do the following: overestimating the accuracy of his beliefs in an economical or statistical measure. Being overconfident about historical data is dangerous for many reasons. Black swans, the reliability of the data, the fact that the market might have changed, and data fitting are some of them. Getting married to his positions. There's a saying that traders divorce spouses before positions. Don't be that guy. Changes his story. He becomes a long-term investor all of a sudden when he's losing money on his positions. After all, he doesn't want to sell now when it's even better value. He never considers that his way of determining value might be what's wrong. He has no plan for how to take losses. Because he doesn't think that he can lose money when taking a trade, he doesn't have a game plan for how to react in the event of this happening. Always predefine your risk. He is in denial. Once he finally accepts his losses, which is way too late by the way, he refuses to believe that it was his own fault. He was simply unlucky. What's funny is that when he earns money, remember Martin the Monkey from takeaway number 1, he attributes it all to skills. In the eyes of the market fool, losses always happen due to randomness.
So let me stop things right there. We're getting close to the end of class, but that's the basics of it right there. These last 5 things that he was talking about were really related to more behavioral issues. There's a whole list of literature that was started up by 2 very well-known authors, Kahneman and Tversky, who again are Nobel Prize winning researchers in economics, even though they are psychologists. But they laid out these various behavioral biases that we all walk around with. We don't want to recognize the loss because it's painful, so we'll be in denial. We also are overconfident and things of that nature. And by the way, for you ladies in the class, there's also a gender bias, right? Men tend to be more overconfident than women. The studies have clearly shown that. So if anybody should be trading, it's probably those of you who are women in the class. Us guys are going to be overconfident, and we're probably going to lose more for that reason. Anyway, I thought that was an interesting little take. Hopefully you did too. We'll continue on to the rest of Chapter 7 on Tuesday. Make sure that you don't forget the BMC by Sunday night and then get the reading in for 7 and 8. As soon as class is over, I'll try to get that assignment created for, hopefully Connect is working now. But that's the assignment regardless. If you want to start it right now, just go to Chapter 7 and start reading. Other questions before we go? All right. Thank you very much. I'll see you on Tuesday. Have a great weekend. Enjoy the weather. It's nice out there.